Hello, everybody. Today is August 12th, 2022. We're back for some market commentary today. Got a lot to talk about, so we'll get to it. My name is Sam Chaplin. I am here with Jim Bradley, our CIO and founder. How's it going today?
Doing great, thanks. Been about a quarter since I've seen you, so it must be about time to do another quarterly commentary.
It is about that time. It's been moving fast. Hope everybody's been having a good summer. But let's jump right into it. Jim's going to talk a little bit about how the markets have been performing so far this year. Or not performing.
No big headlines are going to be broken here today. We're going to talk about a market that really did kind of fall out of bed the first half of 2022, and arguably or statistically the worst half of the year, first half of a year since 1970 in the stock market. So those of you who out there who were born after 1970, and those of you here who were born after 1970, will appreciate that this was the worst first half in your lifetime. Having hit a bottom somewhere around the middle of June, I think it was around June 15th or June 16th, we saw the lowest point that we've seen so far in the S&P 500. And actually, much in line with what a lot of analysts and economists were kind of calling for, the second half of the year has picked up a little bit. The thought was peak inflation might have occurred, and that might take some of the pressure off of stock performance. But of course, stock markets are a little bit of a forward-looking mechanism, so that's brought them up off of their bottoms a little bit because they think that there may be a little bit of past tense with inflation going straight up. We'll talk a lot about that soon. Interestingly, the trailing 12-month performance, for those of you watching right about now and feel like the market's just been going down forever, is only down about 4% over the last 12 months only. Actually, the 3-year performance is up about 51.5%. So I think that we can take this little interesting but not very pleasant first quarter, keep it in context of a market that goes up and down from time to time, and this is actually probably appropriate and an expected volatility that we've been going through.
Yeah, important to keep the time frame in mind. Everybody's memory gets real short when the market's down 22%. But here we are down 10 and had some really good years coming into it. So anybody who's stayed invested is still much better off than not investing.
The financial planner part of me says plan on this kind of stuff because it happens and it will happen again. Bear markets happen.
Yeah. At least in the equity market, but we'll talk about the bond market now. It's a little less common performance so far this year.
Yeah, bond market investors, at least again in our lifetime, haven't been all that very used to the bond market going down. If you look up, if you Google 60-40 portfolio in the on the Google machine, you're going to see articles like, is the 60-40 portfolio dead, and that type of thing, because yeah, bond market performance was bad as well. Depending upon how you measure it, could be the worst first half for bonds ever. It's one comforting thing is to know that bonds are typically a little bit more of a conservative investment, and this index that we track here, the Bloomberg Barclays Aggregate U.S. Bond Index, has never seen 2 consecutive negative returns in consecutive years. So I hope that portends good things for the upcoming trajectory in the interim. But going to the next slide here, one of the things you'll see is that, while the stock market certainly has had its ups and downs, bond market on the bottom has kind of crept up a little bit more, regularly until recently. So what went wrong here? If we're using bonds to absorb some of the risk of the stock market, why did they both go down at the same time? It doesn't usually happen that way. Usually when the stock market is turning negative, a big part of that is that we've got bad economic news. And I've been telling a lot of people lately, the problem with this stock market has not been bad economic news. The problem with this stock market is that the economy is running too hot and creating inflation concerns. And so as a result, interest rates have had to go up. And when interest rates are risen, or at least expected to be risen relatively aggressively, that hurts stocks. because companies can't be quite as profitable in that kind of an environment, and because discount rates end up being exaggerated, reducing the present value of future earnings. Not to get too geeky there, but with bonds, the same type of dynamic hurts them as well, because if you're holding a bond that that yields a certain percentage rate, but new percentage rates are higher, it's going to make your bond less attractive, driving down the price of your bond in the open market. So rising interest rates, not good for US bond prices, not good for bond prices pretty much anywhere. And as a result of that, we're seeing for the first time in a long, long time, a period where bonds and stocks, for a relatively prolonged period, for the first half of the year, tracked in concert with one another in the downward direction.
Yeah, particularly painful year so far for conservative investors with a lot of bond allocation in their portfolio. In the equity market, there's the risk there. The 20% drawdown is not necessarily at a line. It happens from time to time, as you can see in that top chart. But on the bottom chart, you can see how drastic that drawdown in bonds has been, one of the worst ever. So definitely feeling for the people on the bond side out there. But we get some good news ahead, and things have turned around a little bit over the last month or so. But as Jim was saying, what went wrong? Why are the markets down so much? Why do they both go down so much? A couple of things we've touched on. Again, not going to be a surprise to anybody, is inflation and the probability of recession, or the probability of growth turning negative in GDP. And these two things are very much related. It's a little bit of a balancing seesaw act going on, where the Fed needs to hike interest rates to try to quell inflation, but that's also going to slow growth. People aren't going to be buying as much. When mortgage rates are 6% instead of 3%, that really slows down people's demand. And if you do that to too much of an extent, that'll push us into recession, and growth will actually turn negative. So those two are very much related. And that's the balancing act where you see the market swings going on. People worried about inflation one day, worried about recession the next. So a lot of back and forth there. And then the third one that's kind of been a cloud hanging over the markets is a lot of geopolitical conflicts going on. Mostly the war in Ukraine, but also rising tensions with China as well. Markets are historically pretty good at, not getting too hung up on the geopolitical stuff until it starts to really affect the business case. So far it's been kind of on the back burner, but certainly something to keep an eye on. So I'm going to talk about inflation a little bit first. We did get some positive news on this past Wednesday, where the CPI, Consumer Price Index, dropped from 9.1% year over year in June to 8.5% year over year in July. So that's a much welcomed development. There's a big drop in energy prices, as I'm sure everybody has noticed, and that was offset a bit by continual increases in prices and things like shelter and food. So those washed out a bit. But good to see that's moving in the right direction. We're hoping this is a peak. There's no promises there, but definitely a step in the right direction. Talk about the causes of inflation a little bit, because it's been a hot topic. A lot of political blame games going on out there. So let's talk about what we think are some of the causes of inflation. And you can see how it's not one thing or another, but pretty dynamic, complex situation going on. Number one, I'm going to put here, obviously, is the pandemic shocks. Huge hit to demand when everybody got locked down. And then as the economy reopened, supply couldn't catch up in time. That broke a lot of supply chains. And now we got too many dollars chasing too little goods. And that's really the underpinning factor that's been causing inflation this whole time. But there's a lot of things that certainly haven't helped. The Federal Reserve monetary policy created $4.5 trillion of money, something like that, really stimulated people's bank accounts. They went out, they lowered interest rates as well. So that's when you saw a giant rush for people to buy things like houses and cars, and really pushed up the prices of those things. There's a lot of talk about the Fed was, really stimulated that demand, and then was too late to start hiking interest rates to start to tamp down that demand. So there's a lot of blame going on towards the Fed. But the third thing in here was really a curveball that Fed didn't necessarily see coming. They were working with the best information they had at the time, which was the war in Ukraine that is ongoing. And obviously we send our love to everybody over there. But really messed up supply chains, added fuel to that fire even more, especially the energy markets. And when energy prices go up, that really flows through into the prices of everything. So that was really a not helpful situation that developed. Obviously, Putin probably made that choice at that time because he knew the effects it would have on the global economy. Next up, government stimulus. That's another about $4.5 trillion of money that the government borrowed and sent out in stimulus checks and all that type of stuff. So that certainly helps stoke demand again, and with supply chains not being able to catch up. continue to drive inflation.
Good news there is that I've already spent mine, so I'm hoping that's the case across the board. That could stop a little bit of the surge that we've seen, hopefully.
Yeah, I don't know how long you can blame $1,400 checks when grocery prices are going up 10% every couple months, but certainly a factor. Corporate profiteering is something you might hear about. They say in business, sometimes you don't let a good crisis go to waste. And there's certainly been some of that going on where companies have been given a good excuse to raise prices so that in some cases they've done it whether they needed to or not. And one demonstration of that is that profit margins across the S&P 500 have actually gone up over the past 2 years pretty dramatically. So you could figure if companies are only raising prices to offset the rising costs, then those profit margins would be pretty stable or shrinking. But the fact that they've expanded shows that companies have raised prices in many cases more than they needed to. And then the companies, on the other hand, are going to blame this wage price spiral. And what that is that when prices go up, employees go ask for raises because they can't afford their cost of living anymore. So then companies start paying those employees more. Those employees go out and spend more money, fuel inflation, prices continue to go up. And then it just becomes a cycle of employees going back, asking for raises because prices are going up, and prices are going up because employees are spending more money. So that's another factor as well. And a reason that people are really watching the labor market at the moment. A really tight labor market means wage growth grows faster, which can help fuel inflation. So that's another factor going on. And then the lockdowns in China, finally, the zero COVID policy over there has really hurt manufacturing and in trade. So it's another area where just different elements around the world are helping fuel inflation. And it is a global phenomenon. It's not something just happening here in the US. It has to do with the fact that you can't just shut down the entire economy, give everybody a ton of money and open it back up without being the price to pay. And as we mentioned, there's a political blame game going on that can really be disproved in about 30 seconds. So I'm going to go ahead and do that. Gas prices. Everybody's been watching gas prices. You got the Republicans on one side saying this is all Joe Biden's problem. He did all this. And then you get the Democrats on the other side saying this is all Putin's problem and the Putin price hike or whatever they want to call it. So if you look at gas prices since they bottomed out in about the middle of 2020 and have been on the rise ever since until very recently, you can see that when Joe Biden took office, gas prices were already up over 31%. So it's hard to say that he did that before he even got into office. And by the time Putin invaded Ukraine, gas prices were up almost 94%. So it's hard to say this all had to do with Putin. And then finally peaked out there in July or late June, rather, around plus 173%. This chart's a couple days old. I actually saw that national average is now below $4 for the first time in a few months. So that's good to see. I'm sure everybody appreciates that. But just important to keep in mind, these are very complex dynamics that go on that have a lot of factors behind them. I think there's a large disservice being done to people with the politicians trying to make this a blame game of one person did this or another.
The whole blame game thing is just unproductive. I mean, at the end of the day, the true culprit is the New York Yankees, and keep that in mind.
I think we can all agree on that. And this gas prices come down is actually part of a larger complex called the commodity complex. When you think of commodities, you can think of natural resources and raw materials that go into production, things like energy with fossil fuels and natural gas and coal and all of that. You got your agriculture in there, corn, soybeans, pork belly, whatnot. And then you got your metals as well, copper, iron, gold, silver, it's all in there. So these are really the materials that companies use to create their end product. And those prices went up dramatically towards the beginning of the pandemic and until pretty recently, where demand was really outstripping supply. And we've seen a nice come down in those prices over the last couple months. The good news is that's going to help ease some of the inflationary pressure, at least on the manufacturing and goods side. The bad news is markets are a forward-looking instrument, and part of the reason these prices have come down is because traders are starting to smell a recession around the corner. And when they get a whiff of that recession, people tend to flee commodities because in a recession, demand drops and therefore prices drop as well. So you don't want to be long on commodities in that situation. So good news, bad news there. But I think we'll all take it at the gas pump and be pretty happy with that.
Yeah.
There's also been a transition, which was been anticipated for a while, of inflation moving from the goods side to the services side. You can think early on in the pandemic when everybody was locked down and interest rates were really low, they went out and bought cars, houses, bicycles were a big one. that drove a lot of inflation on that goods side. And now that the economy's reopened, people are entering the summer, people want to go, fly and get hotels and have their house worked on, hire labor, all that type of stuff. And those services have been where more of the inflation has been happening in recent months. So a big transition there. The ugly part is that service inflation tends to be a little more sticky. People that manufacture goods tend to reevaluate those prices and change them pretty frequently, where on the services side, it doesn't happen so much. Something like rent is a service as well. And, you don't see a lot of landlords out there reducing rent too often. So that's just a way that when the inflation gets too deep into the services side, it tends to be more pervasive and persistent. So that's our thoughts on the inflation side. Get some good news recently, and we hope it continues. And then the other side of this equation is economic growth. So I'll have Jim talk a little bit about that.
Yeah, a couple of slides ago, Sam, you brought up the R word, recession. And I don't know about you, but back when I was in college, back in the 1900s, we went through economics 101, and I'm pretty sure somewhere on that animal skin that we took notes on at the time, I had jotted down that a recession was simply 2 consecutive quarters of negative GDP growth. And if you look at this chart, you can see that the beginning 2 quarters in 2022, we had minor negative GDP numbers. So are we in a recession? And the term technical recession has been tossed around quite a lot. I don't know who determines what a technical recession is or not, but I guess a technical recession is 2 quarters of negative growth. In reality, though, to be a little bit more precise about what a recession is from an economic standpoint, there's an organization called the National Bureau of Economic Research that has taken the role of telling us when there's a recession, and we thank them for that. And they look at things like GDP growth as one part of a much bigger puzzle. What they're really trying to get is, in general, is there economic contraction happening? And so GDP measures kind of the gross output of all goods and services that a country produces. But you look at things like our defense spending, that came down a little bit in the first and second quarter. You look at trade balance, where we are importing more things than we're exporting, and that trade imbalance grew a little bit in the first and second quarters. Not really such an issue about how the economy is doing. It's more like a couple of things that feed into that number were causing it to go negative. And I think that's what the Bureau of Economic Research is looking at when they say, no, we haven't really called a recession yet. And they're looking at a lot of different things at the same time. They're looking at employment numbers, which, we got a big surprise last week, doubled the expectations as far as new jobs being created. We're now at a situation where more jobs have been created than were lost in the pandemic. So we're back to piling on to what we had back in late 2019, early 2020. Industrial production hit a big divot back in the recession, the very quick flash recession of 2020, came back in spades and is now kind of worked off to a kind of normal run rate. And retail sales, which dropped a little bit earlier in the recession, jumped up pretty significantly afterward, and they're still at relatively elevated levels relative to where we were back before the pandemic kind of shut things down. So I can see what the National Bureau of Economic Research is looking at when they say they're not so sure this is a recession yet. Not to say that we might not be headed for one. And Sam will talk about some indicators that make us think that it could be a possibility that we see one. But what we're in right now doesn't have the look and feel to a lot of the economic researchers that would be typical of a recession.
Yeah, it's interesting to see when we get the market and the economy are at odds once again, as they were earlier in the pandemic, and when we get a good jobs report, which is great for the economy. The markets don't react so well because a tight labor market means wages are going up, and that's going to fuel inflationary pressure. So you see the market and economy at odds again. And the question is, can we have a real deep recession if the labor market is this tight? Can we have a really prolonged one? It's difficult, right? People still have their jobs, they're still getting paid, they're still going out and spending money. So until we start to see things like employment turn down, or industrial production for that matter, it's hard to have a really deep, prolonged recession. It's going to be one of those more technical type recessions where some of those other factors are affecting us. And then the question is, does the Fed have to raise interest rates so high that it starts to break the labor market in order to cure the inflation issue? That do they want unemployment to go up so people aren't making so much money and spending so much money, because that will help the inflation story. But I think most people that are not Fed Reserve board members would like to see employment stay strong, especially when they hike interest rates like that to raise unemployment. It tends to hurt people at the bottom of the spectrum who are already struggling. So hopefully that we can push through. Last thing I wanted to talk about for our outlook is the geopolitical situation. Talked a little bit about, everybody knows what's going on in Ukraine. Everybody knows that there've been some tensions rising with China, Pelosi's visit over there. And these things, the market tends to do okay with them until they start to really impact the business case. And where this starts to impact the business case is if all these geopolitical conflicts are increasing, plus all the issues we had with supply chains during the pandemic, is that going to lead to us deglobalizing the economy a little bit? And, there's been a huge tailwind over the last few decades of globalization leading to lower prices as you can outsource everything to a place that can specialize in that thing, and that helps keep prices low. But the downside is we are less reliant on being able to produce the things we want ourselves. And then when a crisis hits, we get the type of issues we're dealing with right now. So which side of that is more important? Will this lead to deglobalization, which would actually be an inflationary pressure as we try to reshore a bunch of these industries? And that's where it enters a business case. So that's kind of a cloud hanging over the market at the moment. That'll certainly be something we keep an eye on. So what everybody's probably wondering is how we look in the markets. Talk a little bit here about valuations in the bond market and the stock market. First, with valuations, talk a little about earnings outlook and just general investor sentiment. First off is interest rates, which is really the vector through which all this stuff enters the market, right? Expectations for inflation and growth get priced into interest rates, and then those interest rates are used to value both stocks and bonds. So it's really the inroad. And right now you can see the blue line of how the interest rates have changed since the beginning of the pandemic, dropping to almost zero initially, some small hikes there beginning earlier this year, and then some big hikes as the inflation numbers didn't come down as quickly as hoped. So we've had a couple 75 basis point hikes. We're expecting one more at the next meeting in September. And that gray line is showing where markets currently expect interest rates to go, which is, like I said, another 75 basis point hike in September, followed by a couple smaller hikes and hitting a terminal rate around 3.61% in either February or March. And then at that point, people are thinking inflation is going to start to be under control, but we're going to be at risk of growth slowing into a deeper recessionary stance. And then at that point, the Fed's going to have to immediately start dropping interest rates to help support the economy. So that's the outlook right now. How you view bonds depends on whether you think this outlook is too optimistic, not optimistic enough. Do you think inflation is going to last longer than this? Do you think that the interest rate hikes are going to push us into recession much sooner than February or March? That's how you would judge bonds right now. And then the bond market is also sending some scary signals with a yield curve inversion, which is when shorter term yields are actually higher than longer term yields, which is not typically the case. And that reflects the fact that bond investors think there's a lot of risk embedded in the next couple of years, and then things smooth out after that. So one way we look at that, and popular one, is the 10-year versus the 2-year spread in yields, which right now the 2-year is yielding 45 basis points more than the 10-year, which is a pretty deep inversion. And that shows the bond market is not too optimistic about what's going to happen over the next 2 years with the economy. So a bit of a warning shot there. Another way to look at valuations for corporate bonds is looking at the spreads. And credit spreads are the difference between what a treasury would yield, pretty safe bet, versus what some riskier, higher yielding corporate debt would yield. So example, that top line at 9.94% for CCC or below kind of junk rated bonds, those bonds have to yield about almost 10% more than a treasury to attract investors. And this is a measure of how much risk investors think of default that investors think are embedded into the next few years. bond returns. And we can see they've come up quite a bit over the year, reflecting that probability of recession have certainly increased. But when you go to the longer term chart here, you can see they're up, but still not nearly where they would be or where they have been for past recessions. So a little bit of a half step there of getting nervous, but still not nearly to the level of nervous they were in the past. And that reflects the fact that the labor market's still really strong. Corporate balance sheets are still really strong. Earnings estimates are still really strong. Really, all that stuff that would typically precede a recession in a deep, dark recession is not really manifesting yet at this point. So something we'll keep an eye on.
Yeah, it's a big example of how sometimes taking a step back and looking at things not so close up, like in the course of a year, but looking at them in historical context can tell a very different story than what you're seeing up front. Arguably, objectively, yield spreads are not all that very big right now. So corporate debt is not looked at as being very risky right now, I guess, in a lot of ways. And I think a lot of that has to do with the fact that balance sheets, both on the consumer side and on the corporate side, are actually looking a little bit better than they historically have on average. Companies are still sitting on a bunch of cash right now.
Yeah. And with these spreads up quite a bit, if for those who think that the economy is not headed towards recession and there's not going to be a ton of defaults, there's actually some pretty attractive yields out there on the bond market side, which hasn't been the case for a while. So some of the higher yielding debt getting 4, 5, 6, 7% is attractive if your outlook is strong.
One of those things where something that's done poor lately might be a good investment, is what you're saying, Sam.
Indeed. Yeah, time to buy is when everybody's scared.
Funny how that works.
Yeah.
I like talking about the bonds, but you got the bonds this time. I get the stocks this time. So I'll take a stab here at the price to earnings ratio. For those who have heard me talk about this a million times, you know that I'm interested in the price to earnings ratio, but I'm also very interested in the flip side of the price to earnings ratio, or the earnings to price ratio, which is the earnings yield, because I think that tells the story a little bit more of an understandable way. Right now, price to earnings ratios are off their high levels. In other words, what you pay for a dollar's worth of earnings is a little bit lower than it was at the beginning of the year, meaning the market objectively isn't quite as overpriced as it was then, and more in line with long-term averages. But the question is, should they be in line with historical averages, or should they be higher or lower than that? That's where flipping that number upside down tends to be a little bit more helpful. If you look at this graph, you'll see that the forward price to earnings ratio is about 16 to 1, 16 price to $1 earnings. So if you flip that upside down and do the earnings to a price ratio, $1 earnings to a $16 investment means you're getting about between a 5.5% and 6.5% rate of return on your investment. Is that a good thing? Well, it was a really good thing back when we were yielding, not very much of anything on good quality bonds. But looking at it right now, when the bond yields are actually, as you just said, Sam, a little more inflated, is this defensible, or do those price levels have to come down to push that earnings yield up? So it'll be an interesting thing to say. But overall, that price to earnings ratio would be expected to trend lower if we had higher interest rates, and as a result of higher inflation. So that's a headwind for the market as we see it right now. And if we go to the next slide, we'll see that this ratio is a bit at right now, I guess 18.71. So just maybe a little bit more than a 5% earnings yield is what we're getting when the 25-year average is at 16.85. Again, higher than usual. Other things like price to book, price to cash flow, those are higher. And dividend yield, which is again kind of on that flip side of things, lower is indicative of maybe a more expensive market, because a dividend is how much dividend you're getting for each unit of price on the stocks. So as the price goes up, dividend yield will go down unless the dividends keep up, and that's a little bit lower. So a lot of things are telling us that the stock market is relatively optimistic looking into the future, and B, I'd argue, has some relatively decent sized headwinds to have to compete with. So, some of the volatility that we've seen recently might not be completely over. As to the question of, have we seen the bottom in this particular bear market? Are we looking at a bear market bounce or dead cat bounce? That's yet to be seen, but I think that I'm not going to be proven terribly wrong when I say some degree of volatility is in the offing for the stock market over the foreseeable future.
Yeah, definitely seen prices come down well off those uncomfortable highs, but still a little bit overvalued to the long-term averages. And again, if you think things are going to return to normal, it's a good place to be. If you think we're going to be in kind of a lower growth, higher inflation scenario for a lot longer, we're probably going to see prices go down further in that scenario.
Now, on the other hand, Sam, I'll throw in that if economists are out there that are right, and inflation is going to start to trend down, and those, the yield environment is going to become a little bit more accommodative, then going to the next slide is going to show you, I think, what part of what the stock market's looking at right now and allowing itself to be a little bit above trend, which is that consensus estimates from the analysts out there are expecting that we're not going to see a really significant reduction in S&P 500 company earnings. They're expected to continue to trend upward over the next few years. And if that's the case, the argument could be made that the prices that we're seeing on the market right now are just looking at that down the road and looking at this inflation thing as being something that rectifies itself over the shorter term.
Yep. Yeah, it makes sense. I mean, last quarter's earnings was much better than feared. I think a lot of people were expecting a lot of doom and gloom from guidance from companies saying, we're laying everybody off and we're headed for a deep recession. That certainly wasn't the case. So a lot of optimism out there. If companies remain strong, the labor market remains strong, maybe we can grow our way out of this. But speaking of, fears, looking at investor sentiment, we've seen that come off the low on the top graph there, with about 8% more investors being bearish than bullish at the moment. It was over 40% more being bearish for a minute there. So that was a pretty deep bearish tilt. But I always love putting these graphs right next to each other, because you can see when the tilts are the most bearish, if you draw a straight line down to where the market is at that point, not usually a good time to sell, historically speaking. It kind of shows how psychology often does not work in your favor in investments. And when you think there's no hope, it's actually a better time to buy than it is to sell in most cases. So that's something we try to make sure we tell our clients, that you don't chase returns in and out of markets. You instead do exactly the opposite, and you buy when things look bad, and be more conservative when things are overly optimistic. So I think at the moment we've seen that happen once again here so far the last couple months, where that investor sentiment got very bearish, and then that really leaves room for the bulls to come in and really make some big moves in the market, as they have done the last month or so.
I guess going back to my Econ 101 textbook there, this would be considered a contrary indicator.
Indeed. Great. Well, that's our last slide. I know we kept you guys for quite some time, but thanks for joining us. Give us a like on Facebook, LinkedIn, put some more content out there if anybody's interested. So that's my plug. But otherwise, hope everybody enjoys the rest of the summer, and we'll see you next quarter.
Enjoy it. We'll see you next quarter.
The foregoing content reflects the opinions of Penobscot Financial Advisors and is subject to change at any time without notice. Content provided herein is for informational purposes only and should not be construed as investment advice or a recommendation regarding the purchase or sale of any security. There is no guarantee that the statements, opinions, or forecasts provided herein will prove to be correct.